Good morning. This is Jay Clayton, and this is an open meeting of the U.S. Securities and Exchange Commission under the Government in the Sunshine Act.
And good morning. This is Chairman Heath Tarbert of the Cftc. This meeting will come to order. This is a public joint meeting of the Commodity Futures Trading Commission and the Securities and Exchange Commission. I'd like to welcome members of the public and market participants who are listening on the phone or through the web. I'd also like to welcome my fellow commissioners on the CFTC, Commissioners Quintens, Benham, Stump, and Berkovitz. And of course, I'd like to welcome SEC Chairman Clayton and the SEC Commissioners Hurst, Roisman, Lee, and Crenshaw. At the outset, I'd ask for the cooperation of those who are speaking during the meeting today in observing a few good practices for the benefit of our listeners and for those who may listen to the recording of this meeting in the future. Number one, when you're about to speak, please ensure your phone line is unmuted. Two, as you begin speaking, please identify yourself. For example, this is CFTC Commissioner X or this is SEC Commissioner Y. And finally, when you're not speaking, please keep your phone line muted. Before we move to Chairman's opening statement, we have a tradition at the CFTC of starting our meetings with the Pledge of Allegiance. It reminds us that we're all in this together, that our job is to focus on what's best for the nation, and that we're always constantly pursuing liberty and justice for all. So anyone is welcome to join me in the pledge. If you'd like to do so, please unmute your line at this time. I pledge allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Now I'll turn to Chairman Clayton for his opening remarks.
Thank you, Chairman Tarbert, and I echo your thanks to my fellow commissioners, your fellow commissioners, and all who made this joint meeting possible. Today marks a milestone in the 45-year relationship between the SEC and CFTC as we hold the first joint open meeting to both consider and vote on policy initiatives. I want to thank you, Chairman Tarbert, for suggesting that we come together like this, and again, all of those who made it possible for supporting this meeting, but more importantly, the continuing coordination among our agencies. Over the years, and as most recently evidenced by the standing up of the Dodd-Frank Title VII regulatory regime for swaps and security-based swaps, America's investors have benefited from our agency's commitment to working together to ensure that our regulations are effective, consistent, mutually reinforcing, and efficient. In certain cases, these important objectives are best served by harmonizing our rules. Today's recommendations from the CFTC and SEC staffs demonstrate that commitment to harmonization where practicable. Specifically, the commissioners will consider 1, rule amendments related to margin requirements for certain positions, and 2, a request for comment regarding portfolio margining. Particularly with respect to portfolio margining, I expect today's recommendation will mark the beginning of a close collaborative process to align better our approaches to the important regulatory objectives underlying our respective margining requirements. Likewise, I am looking forward to our staff's continued productive engagement on swap and security-based swap interpretations as the new regulatory regime becomes effective. I want to thank our CFTC colleagues for their coordination and collaboration on Title VII issues as we stood up our new regime. And in particular, I would like to thank Commissioner Peirce from the SEC and CFTC Commissioner Quintens for their leadership in this regard. We have a more formal thank you to them coming at the end of today's meeting. Before turning to Chairman Tarbert for his opening remarks, I want to thank the CFTC and SEC staffs again for their work on the matters being considered today. In particular, I want to acknowledge certain members of the SEC staff. From the Division of Trading and Markets, Brett Redfern, Lizzie Baird, Ajay Sutaria, Mike Macchiaroli, Tom McGowan, Randall Roy, Ray Lombardo, Sheila Schwartz, and Abraham Jacob. From our Office of General Counsel, Meredith Mitchell, Robert Tepley, Donna Chambers, and Brooks Shirey. From the Division of Economic and Risk Analysis, S.P. Kothari, Hari Patek, and Chantel Hernandez. Finally, I would also like to thank the CFTC for hosting this meeting virtually, including the CFTC's Office of the Secretariat and the Office of Data and Technology for their hard work on today's meeting. Now over to you, Chairman Tarbert.
Thank you very much, Chairman Clayton. This is CFTC Chairman Heath Tarbert, and also want to say that it's an honor to be here for what is a historic moment. As you mentioned, this is the first ever joint open meeting of the SEC and CFTC to vote on a final rule in our shared 45-year history. So, of course, I want to thank you, Chairman Clayton, and the rest of the commissioners, both on the SEC and the CFTC, for making this joint meeting happen. Since the 1930s, securities and futures products have been subject to separate regulatory regimes in the United States. This is because at their core, the SEC and the CFTC monitor different markets with different market participants. While certain securities markets, such as securities options, facilitate the transfer of risk, the SEC is primarily focused on capital formation. By contrast, the CFTC concentrates its efforts on risk mitigation with a historic emphasis on America's agricultural and energy producers. Indeed, the unique capital formation role of certain securities markets has informed the manner in which our two regimes have developed, and in part explains differences between the regulatory structures of the SEC and the CFTC. This distinction is also reflected in our Commission's reporting lines to Congress. While the Banking and Financial Services Committees have jurisdiction over the SEC, the CFTC falls under the jurisdiction of the Agriculture Committees. The characteristics of the markets we regulate go a long way toward explaining why we sometimes take a different approach to regulation, or at least see regulatory issues through different lenses. I recognize that some critics argue that the U.S. financial regulatory system is fragmented, inefficient, and too often plagued with petty turf battles. However, we've got to keep in mind that the U.S. has the biggest, deepest, and most liquid financial markets in the world. It's therefore appropriate that we have two market regulators, one, the SEC, that focuses on capital formation, and another, the CFTC, that focuses on risk mitigating hedging. There's a compelling logic to our regulatory structure. Now, despite that logic, it's true that in the past there have been instances where our agencies have disagreed on how to classify certain financial products. Some of those disagreements have even led to litigation. Given our somewhat overlapping interests, it was inevitable that frictions would arise. After all, brothers and sisters often fight. But our agencies also have a history of cooperation. Most notably for today's meeting, the SEC and CFTC chairman signed the Shad-Johnson Accord in 1981, which provided for joint jurisdiction over single stock futures and narrow base stock indices. The Shad-Johnson Accord was later codified by Congress in the 1980s and further revised in 2000 with passage of the CFMA. Since the enactment of the Dodd-Frank Act in 2010, our agencies have tried hard to work together because we know the American people are depending on us. We've held joint roundtables on a variety of topics important to market participants and established the joint CFTC-SEC Advisory Committee on Emerging Regulatory Issues. We've also consulted on the implementation of Title VII, and in the past year, we've continued that tradition of collaboration while taking it to the next level. Going forward, I believe continued communication and coordination will benefit both agencies as we confront the opportunities and challenges presented by our evolving markets. Today, we're going to talk about two topics that are emblematic of the overlapping jurisdiction of our two agencies and that demonstrate our mutual commitment to regulatory clarity: securities futures margin and portfolio margining. Once again, I want to thank you, Chairman Clayton, and the rest of the commissioners for participating in this joint meeting, and I want to thank the staffs of the two agencies for working so closely together on these two agenda items. And particularly, I want to thank the two offices of the Secretary who have toiled behind the scenes to make this joint meeting and all of our open meetings possible. Well, now we'll move on to consideration of the final rule amending customer margin rules relating to securities futures. After the presentation, the floor will be open for one round of questions and remarks from each SEC and CFTC commissioner. Following the close of discussion, the commissions will each vote separately on the rule. The final votes conducted in this public meeting will be recorded votes, and the results of votes approving issuance of rulemaking documents, at least in the CFTC's case, will be included with those documents in the Federal Register. To facilitate the preparation of the approved documents by the CFTC for publication in the Federal Register, I'd now ask the CFTC commissioners to grant unanimous consent for staff to make the necessary technical corrections prior to submitting them to the Federal Register.
So moved.
Second. Thank you. So at this time, I'd like to welcome Clark Hutchison, Director of the CFTC's Division of Clearing and Risk, to give the staff presentation on the joint final rule relating to customer margin rules for securities futures. Clark, the floor is yours.
Good morning. Just doing a sound check to make sure you can hear me, Mr. Chairman.
Loud and clear.
Thank you. Good morning, and thank you, Chairman. And good morning to both of the commissions and all of the staff and members of the public participating in this joint CFTC and SEC open meeting. My name is Clark Hutchison. I am the Director of the Division of Clearing and Risk at the CFTC. I am joining you this morning from my home office in New Jersey. Like many Americans, my team and I have been finding new ways to work together in this virtual environment. We've been managing extraordinarily well, and I have to say that working on this joint rulemaking with our colleagues at the SEC has been a similarly positive experience. As a result of these collaborative efforts, we are able to present a final rule for both commissions to consider. As the chairman noted, this is an unprecedented meeting of the commissions. Today, SEC and CFTC staff are pleased to recommend that the commissions adopt final rule amendments to modify the customer margin requirements for security futures. I would like to begin by briefly explaining the joint jurisdiction over security futures and the current margin requirements for these products. Then I will describe the final rules under consideration today and provide an update about security futures trading in the United States. A securities future is a futures contract on a single security or on a narrow-based securities index. In December 2000, the Commodity Futures Modernization Act, or CMFA, became law. The CMFA lifted the ban on security futures trading and established a framework for joint regulation of security futures. Under the statute, the Board of Governors of the Federal Reserve System delegated authority to establish minimum customer margin levels for security futures positions to the CFTC and the SEC jointly. In 2002, the commissions adopted joint margin rules for security futures. These rules, which have not been amended since 2002, require security futures intermediaries to collect margin from their customers equal to 20% of the current market value of each long or short position in security futures. The rules also permit a self-regulatory organization to require initial and maintenance margin that equals less than 20% of the current market value for certain strategy-based offsetting positions. When adopting the 20% margin requirement, the commissions considered the provisions in the Securities Exchange Act of 1934, the Securities Exchange Act, that govern the minimum initial and maintenance margin required for security futures. In particular, the Exchange Act requires that, 1, the customer margin requirements for security futures must be consistent with margin requirements for comparable exchange-traded equity options, and 2, the initial and maintenance margin levels must not be lower than the lowest level of margin required for any comparable exchange-traded equity option. After the commissions adopted the 20% customer margin requirements, 2 securities self-regulatory organizations implemented portfolio margining rules that permit a broker-dealer to combine a customer's securities and security futures positions in a securities account in order to compute a customer margin requirement based on the combined positions held in the portfolio. As a result, the portfolio margin rules effectively established a 15% margin level for an unhedged position held in the account. Once these portfolio margining programs were offered to customers, there was a potential for inconsistent treatment between 1, an unhedged security future held in a securities account subject to portfolio margin, which would be charged a 15% margin requirement, and 2, an unhedged security future held in a futures account, which would be charged a 20% margin requirement. Given this situation, One Chicago, a security-based exchange offering security futures, petitioned both commissions to modify the joint regulations to allow the same treatment for security futures held in a futures account. In July 2019, the commissions proposed a revision to the security futures minimum custom margin requirements so that positions held in securities accounts subject to portfolio margining and positions held in futures accounts receive similar margin treatment. The commissions proposed lowering the generally applicable minimum margin required for each long or short position in a security future from 20% to 15% of the current market value. This change would permit a customer to hold a security futures position in a futures account or a securities account that does not use portfolio margining to be subject to a minimum required customer margin of 15% of the current market value of the security futures positions. The commissions received comments, data, and analyses from interested market participants and exchanges, which helped inform the final rulemaking. Importantly, these final rule amendments apply only to the minimum customer margin required for securities futures positions. The Commission's margin regimes for securities futures permit self-regulatory organizations to collect higher margin levels from customers in order to preserve financial integrity. In practice, this means that if a security futures intermediary or clearinghouse believes that a higher margin should be required to adequately cover the level of risk presented by a customer's positions, the intermediary or clearinghouse is able to collect additional margin from the customer. Because of this ability to raise margin requirements and flexibility to manage risk, staff are comfortable recommending the change from a 20% to a 15% minimum margin requirement. On September 21st, 2020, One Chicago closed its trading platform for security futures. At this time, there are no exchanges in the United States that offer security futures for trading. Given this, the final rules will have no immediate effect on the security futures market. Notwithstanding the current lack of trading in security futures, CFTC and SEC staff have carefully considered the likely economic impacts of the final rule amendments on investors, intermediaries, and the functioning of financial markets should trading resume. Based on CFTC and SEC staff analysis and review of information provided by commenters, staff anticipates that the final rules may reduce the cost of participating in the securities futures market and could facilitate more trading in securities futures than would otherwise occur. Staff also considered the potential effects of the final rule amendments on competition and expects the amendments to align the margin treatment for customers that use different types of accounts to access the security futures market. The rule change would apply to any new security futures trading in the United States, and addressing the different treatment for security futures positions held in a portfolio margin securities accounts versus futures accounts may provide an opportunity for the security futures market in the United States to operate more effectively in the future. For these reasons, staff recommends that the final regulations, a reduction in minimum required customer margin on security futures from 20% to 15% of the current market value, be adopted as the best approach to achieving similar margin for treatment for securities futures, whether held in a securities account subject to portfolio margining or a futures account. Chairman and Commissioners, CFTC and SEC staff and I are available to answer any questions you may have about these final rules, and thank you.
This is CFTC Chairman Tarbert. Thank you very much, Clark, for that insightful presentation and for the outstanding work in preparing this rulemaking for our respective commission's consideration. In addition to Clark, of course, I'd like to thank the following staff from the CFTC for their contributions to this rulemaking. Sarah Josephson and Melissa Darcy, Deputy Director and Special Counsel, both from our Division of Clearing and Risk, General Counsel Dan Davis, and our Acting Chief Economist, Scott Mixon. For the CFTC to begin our Commission's discussion and consideration of this rule, I'll now entertain a motion from the CFTC Commissioners to adopt the final rule amending the customer margin rules relating to securities futures.
So moved. Second.
Thank you. I'd now like to open the floor for all Commissioners to ask any questions about the rule. I'll begin. And I note that this rule has been in the works for a long time. I think the initial petition came to us in 2008 to both commissions. But since the CFMA lifted the ban on trading security futures, this market has admittedly struggled to develop. And not only that, I think we can probably say at this moment in time, it is effectively dead. But it's interesting because for those of you that may not know, the market for securities futures has taken off in other jurisdictions, such as Europe. And so I am pleased to support this rule because it represents our joint effort to do what we can under the current statutory scheme to make regulation of the security futures markets more efficient by adjusting the margin requirements. And I hope that this final rule will be the first of a number of steps we could take to help jumpstart this market. And again, I think, when you look at this market and you look at alternatives, such as, for example, repos, this market, the futures market, is far more transparent, far less opaque, and can really be potentially helpful to the United States and our market participants who want to hedge their risk and do so through central clearing. So the only question that I have for you, Clark, is I think one of the points you made was very important, which is this rule deals with customer margin, but it doesn't really impact the margin that's held and collected at our clearinghouses. So if we did find ourselves in a scenario where there was a volatility at such a level that required us to collect, particularly for our financial market utilities, higher levels of margin, that this final rule that we're voting on today doesn't in any way change that. Is that correct, Clark?
Yes, Chairman Tarbert, thank you. I think it's important to remember that the final rule today establishes a floor, a minimum margin amount to be levied by clearinghouses or intermediaries. Or said another way, DCOs regulated by the CFTC or clearing agencies regulated by the SEC are free to levy higher margin amounts than the 15% described today, that floor. And they're free to do that if they feel that it is appropriate to mitigate risk under certain market conditions. So in effect, customers cannot be charged less than 15%, but customers can be charged more than 15% should their positions or market conditions signal to clearinghouses and clearing agencies the necessity to mitigate risk. So I feel this rule in establishing a floor leaves room for risk mitigation to protect the financial system at the discretion of the clearinghouses and clearing agencies.
Terrific. And I think it's important that we realize that we're talking about a minimum margin requirement, but by no means what the actual margin requirement could be if we found ourselves in a stress situation where the volatility dictated a higher amount. Terrific. Well, that's all of my remarks today. I'd like to turn it over back to SEC Chairman Clayton for his remarks and potential questions.
Thank you, Chairman Tarbert, and thank you very much, Director Hutchinson. I have a number of comments here in front of me that I will post online, but Clark's presentation was so clear that there is no reason for me to reiterate it. I will just say that this marks a journey another significant step in a journey that started in 2002, and I am pleased that we are continuing on that journey, including bringing the margin requirements for portfolio margin securities accounts and futures accounts into line. Hopefully, as you stated, bringing more life to this currently dead market. With that, I will just thank Clark again for an excellent presentation, and your question around central clearing, Chairman Tarbert, was an insightful one. And with that, back to you.
Thank you so much, Chairman Clayton. CFTC Commissioner Quintens, you have the floor.
Yes, thank you, Mr. Chairman. This is Commissioner Brian Quintens. First, thanks to you and to SEC Chairman Clayton for calling this meeting. If I could just say for a minute how honored I am to join both of you and my fellow CFTC and SEC commissioners to participate today in this first ever joint SEC-CFTC open meeting to consider and vote on rulemaking initiatives. Both of the items on today's agenda showcase the hard work and the cooperation between the CFTC and the SEC staff. It's a cooperation and dialogue I have witnessed personally, and it reminds all of us how critical these staff level and commission level relationships are to ensuring a rationalized regulatory framework for firms and products spanning both the derivatives and the securities markets. Today's meeting is the preeminent expression of that dialogue, one which I have, again, personally witnessed behind the scenes in countless settings in my role leading the harmonization efforts from the CFTC side. That is why, in particular, I am so happy and proud to partake today. Speaking of that harmonization role, I would just like to express my incredible gratitude to Chairman Clayton and former CFTC Chairman Giancarlo for developing that role and for thinking of me for it. Additionally, I'm specifically grateful to Chairman Clayton for his openness to my thinking in our harmonization discussions and also for the relationship that we have developed. And I'm incredibly grateful to Chairman Tarbert for allowing me to continue to serve in that capacity, for taking the personal initiative when needed to move tough issues across the finish line, and for his personal friendship. Lastly, if I could, I would like to take a special moment to thank Commissioner Hester Peirce, who has been my invaluable partner in advancing CFTC SEC harmonization efforts and coordination. Commissioner Peirce has brought intellectual heft and ideological conviction, coupled with open-mindedness to our efforts, and she has done so with a rare combination of both tenacity and grace. It has been an absolute pleasure to work with you to not only attempt, but to actually achieve greater regulatory consistency for swaps and security-based swaps across a number of areas. I believe we've made significant progress in harmonizing capital margin, reporting, examinations, and today's agenda on portfolio margining possibilities. We've been able to keep our commitment to talk both regularly or suddenly. We've been able to champion each other's positions within our own agencies. We've never declared any policy area out of bounds, and we've established trusted lines of communication between our staffs and with each other's chairmen. It's been an absolute privilege to serve alongside of you in this role. Regarding the final rule today, I am going to vote in favor of it. I don't have any questions, but I would like to make just a very brief statement before I thank the staff for their hard work. As was noted before, today's rule indicates that One Chicago, the only exchange that has listed security futures in the United States, has recently discontinued trading operations. That should not mean that we should not do this. This is absolutely critical that we take this step and we proceed with finalizing what has been a long time coming final rule. But the events on the ground underscore the determinative impact statutory provisions can have on both the viability of products and whole business lines. The Securities Exchange Act requires security futures to be margined comparably to options traded on an exchange registered with the SEC. While the intent of that provision is understandable, the economics underlying it appear to be suboptimal. Today's lowering of the required minimum margin, consistent with the Securities Exchange Act, should make trading this product more cost-effective than it has been, but it still may not be sufficiently cost-effective to make the product economically viable. I hope that is not the case, but if it is, I would hope policymakers revisit this provision to ensure that its ultimate effect is consistent with its intent. And with that, I am very pleased to support today's rule. I would like to thank our staff, Clark and DCR, as well as Brett and Mike and Tom, Randall and Sheila, for all of their hard work and for the dialogue we have had. Thank you, Mr. Chairman.
Brian, it's Jay Clayton. Thank you for those very kind words, and again for your work and for your analysis as well. With that, SEC Commissioner Peirce, please.
Thank you, Mr. Chairman. It's such a pleasure to be participating in a joint meeting with our colleagues at the CFTC this morning. And thank you to Commissioner Quintens for your very kind comments. One of the highlights of my time at the SEC has been working with you and the staffs of both of our commissions on issues related to Title VII. It's not the scintillating subject matter that has made that experience so fulfilling, but the shared commitment to preserving and strengthening our capital markets. The cooperative efforts are an important milestone in a relationship that has not been without tensions over the years, as Chairman Tarbert noted. From our first interaction, Commissioner Quintens has exhibited a practical, collaborative approach and a cheerful persistence in tackling difficult questions. I also credit Chairman Clayton, Chairman Giancarlo, and Chairman Tarbert for giving us the room to work together and setting a cooperative tone from the top. Continued commitment will be important as our agencies work through differences and toward our common objectives in the many areas in which we have shared interests. We will always be stronger working together than going our separate ways, and that's exactly what we're doing today with this joint meeting on single stock futures and portfolio margining. As you heard from Clark, the single stock future has a long and tortured history in our markets. Despite this history, as Chairman Tarbert noted, there is potential. Back in 2001, one scholar said that single stock futures would, quote, introduce opportunities for substantial leveraging of individual stock transactions in ways that previously were not available, and they could be used to reduce the regulatory costs of pursuing certain strategies, including short selling. They also provided a theoretically less costly way to pursue certain strategies that investors had used in the options market. Single stock futures, though, never really lived up to their potential. In the years after they started trading volumes remained far below the levels that commentators had initially expected. And as you've already heard, last month, One Chicago, the only U.S. exchange that listed single stock futures, closed its doors. Advocates of this product have argued persuasively to me that our margin requirements have played a role in suppressing interest in the market. The rule that the commissions are considering today takes a small step toward remedying the problem. The recommendation from the staff, consistent with the proposal, is to reduce the margin level for an unhedged equity option held outside a portfolio margin account to 15%, which will harmonize the margin level with the lowest margin level that applies to an unhedged equity option in a portfolio margin account. This change will also ensure that the lowest margin level for an unhedged single stock future is the same across account types. I support this change, but am concerned, as Commissioner Quintens mentioned, that it may not be enough to make the single stock future a viable product. One commenter argued that the proposed rule was, quote, at best a first step, and argued that the Commission would need to permit risk-based margining for this product to thrive. The commissions are working under a less than crystal clear statutory constraint, which Clark read to you, and although I believe that the commissions may have the authority to take a more flexible approach in determining whether the margin requirement for security futures is consistent with and the margin levels are not lower than those for comparable listed equity options, a shift to a risk-based approach would be a significant departure from the approach we've taken to date. Before making that change, the commissions would need to establish that the margin requirements calculated under the approach satisfied the statutory constraints. I'm not persuaded that the record before us allows us to establish that either requirement would be met under a risk-based approach. However, to the extent that my concerns about this change that we're making today not being enough, if this market does fail to develop, the Commission should seek to identify the reasons for the lack of uptake and to determine whether different margin requirements would be appropriate and consistent with the statutory requirements. The SEC, together with the CFTC, where appropriate, may need to engage in a more comprehensive exercise to determine whether a broader reconsideration of its margin framework across the products it regulates is appropriate. I don't have any questions, and I support the rule.
Thank you very much, SEC Commissioner Peirce. CFTC Commissioner Benham, you have the floor.
Thank you, Mr. Chairman. Good morning to everyone. And first, I'd like to thank you, Chairman Tarbert, Chairman Clayton, my fellow CFTC commissioners, and the commissioners from the Securities and Exchange Commission, and of course, all the staff from both agencies who made today possible. It's good to be together to finalize a joint final rule and issue a joint request for comment. Cooperatively working on issues when we are mandated to do so is the floor. When our agencies choose to go beyond that, like today, engaging one another to explore, collaborate, and harmonize our policies and regulations to bring consistency to our agencies' oversight with respect to similar products, practices, market participants, and intermediaries, I believe we provide the highest service to our markets and the American public, and I'm certainly proud to be a part of that effort today. While today's meeting is historical for the voting that will take place, a little more than 11 years ago, the CFTC and SEC held the first joint public meeting in the history of the two agencies. The agencies were asked following the financial crisis to make recommendations via a report to Congress to further harmonize regulation of futures and securities. Following 2 days of public meetings, the CFTC and SEC issued a joint report on regulatory harmonization, making 20 recommendations to enhance enforcement powers, strengthen market and intermediary oversight, and improve operational coordination. Among other things, the joint report reviewed and analyzed risk-based portfolio margining and bankruptcy and solvency regimes, which are relevant to both matters before us today. I think we are following a similar agenda today, and although we are meeting remotely, I think we find ourselves meeting virtually due to the ongoing COVID-19 pandemic. Our senses are heightened as we recover from economic turmoil and pockets of historic market volatility. And now, perhaps more than ever, we must prioritize and promote regulatory activities and policies that will benefit the American public. I am pleased to be supporting this rule today. This rule, as was mentioned, is intended to better align margin requirements of securities futures with those of comparable products. At this time, as was also mentioned, there are no security futures contracts listed for trading on U.S. exchanges, since the only U.S. exchange that had offered trading in such products discontinued operations last month. Nevertheless, the agencies are moving forward towards harmonization that is intended to prevent competitive distortions and is unlikely to result in undermargining for security futures positions should trading resume. I believe the joint rule goes to great lengths in its parsing of statutory language and addressing questions, concerns, and alternatives raised by commenters. In supporting this final rule, I believe it's important to highlight a point emphasized throughout the preamble and one that Clark mentioned as well. The 15% margin requirements being established represent the floor. If security futures trading resumes, futures commission merchants, derivatives clearing organizations, and other security futures intermediaries may charge additional margin above the 15% minimum level required, as well as take other appropriate actions if it would be prudent to manage and protect against increased risk, to preserve their financial integrity, and to protect customers. I believe that the CFTC's regulatory regime for FCMs and DCOs, as I mentioned, provides appropriate incentives and flexibility to manage and mitigate risk, and I'm pleased to support today's final rule. As well, for the vast majority of futures contracts, the margin level generally sits between 3 and 12%. Although this data point should not be determinative of what any contract's margin requirement should be as it relates to the individual product's risk profile, I believe the range clearly indicates that the 15% level, the floor, in the case of today's rule, remains conservative. I look forward to monitoring any developments in this space as and if markets develop over time to ensure results are as predicted and based on what the best available data shows us. If outcomes through economic analysis, surveillance, or market monitoring prove otherwise, I'll be ready to take action immediately. Mr. Chairman, I want to thank you again and Chairman Clayton for bringing us together today. I also want to thank Commissioner Peirce and Commissioner Quintens for their leadership on harmonization efforts over the past few years, and of course, acknowledge all of my fellow commissioners both at the SEC and CFTC. I have no questions for Clark, but do appreciate his work and all staff's work at the CFTC and SEC in bringing the presentation before us today. Thank you.
Commissioner Benham, it's Jay Clayton. I want to thank you for those remarks, and as always, clearly and accessibly giving us some history, the matter we're considering, and also reminding us that our work is never done. Thank you for those remarks. With that, Commissioner Roisman, please.
Good morning, and thank you to Chairman Clayton. I would like to thank Chairman Tarbert, my fellow SEC commissioners and CFTC commissioners, and in particular, would like to also acknowledge the incredible work of Commissioners Peirce and Quintens on all the harmonization efforts that you have done to date. I'm truly pleased to participate in today's joint open meeting with the CFTC. This morning, we are considering two matters involving markets that have explicitly been assigned to the jurisdiction of both agencies: security futures and swaps. Before I turn to the first recommendation concerning security futures margin, I want to take a minute to speak more broadly on the importance of coordination between the SEC and the CFTC, something I believe all of my colleagues have done. But there are more areas where our two agencies actively coordinate besides those for which we have been expressly assigned joint oversight. This engagement is critical to effective market regulation. As we know, cash and futures markets for a variety of asset classes are interconnected. Active market participants often engage in cross-market trading activity across many securities and derivative markets. For example, cash equities markets are closely connected with the markets for futures on financial indices. Prices in the cash treasury markets maintain tight connections to those for treasury futures. Furthermore, many entities that are large players in securities and derivative markets are duly registered with both the SEC and the CFTC. While meetings such as today's are important, regular and routine collaboration among our staffs, premised on candor, collegiality, and cooperation, is a critical component of facilitating effective and efficient oversight. I commend the SEC and CFTC staff for their commitment to developing a close working relationship for the benefit of our markets and investors. Going forward, I hope to see this relationship continue to strengthen. Turning to the first item for us, I support the recommendation to lower the margin requirement for unhedged security futures positions. Over the years, I've heard from many market participants that margin requirements have served as an impediment to the development of more robust demand for security futures. I'm glad that our agencies have chosen to take this step and reduce the required margin level to 15%. As a result of the amendments we adopt today, the margin levels for unhedged security futures held in future accounts and securities accounts that are not portfolio margin accounts will be aligned with those held in portfolio margin accounts. Thus, the amendments provide for consistent margin requirements for security futures positions, irrespective of whether they are held in futures accounts or securities accounts. Furthermore, the level of margin for unhedged securities futures would be consistent with the required margin for unhedged exchange-traded equity options in a portfolio margin account. This is important in light of the statute's requirement regarding the consistency of margin levels between futures and exchange-traded options. While I hope that today's amendments will increase the attractiveness of security futures, as there are currently no securities futures listed for trading on U.S. exchanges, I realize that further steps may be needed to invigorate this market. My door remains open to all those who have other ideas about how to jumpstart demand for security futures. In so doing, we should think about whether our current work is designed to reflect the practical uses of security futures. Thank you to the SEC staff in the Division of Trading and Markets, as well as the staff in the Division of Economic Risk Analysis and the Office of the General Counsel for your thoughtful work. Thank you as well as the CFTC staff for your collaboration on this rulemaking. I have no questions, and thank you again.
Thank you very much, SEC Commissioner Roisman. CFTC Commissioner Stump, you have the floor.
Thank you. Good morning. This is CFTC Commissioner Stump, and I too wish to briefly commend Chairman Tarbert and Chairman Clayton for holding this meeting, and Commissioner Quintens and Commissioner Peirce for their broader efforts to harmonize the regulatory regimes of the agencies, and to all of my colleagues on both commissions for their attention to the importance of our coordination, and to all of the staff who've worked hard to make this meeting a reality today, and in particular those who have put before us today's joint final rule to lower the margin levels for an unhedged security futures position from 20% to 15%. I firmly believe this is sound public policy rooted in years of consideration and tremendous contemplation. And while I don't want to rain on today's parade,
I nevertheless feel compelled to express a few regrets. I regret, for example, that the Commission did not take this common sense step of reducing the security futures margin levels from 20% to 15% years ago. After all, One Chicago, the only U.S. exchange that made a long-term effort to develop a market for security futures, suggested that we consider taking this step 12 years ago. I appreciate that a global financial crisis and the ensuing regulatory focus on swaps and other reforms diverted attention from security futures. But it is nonetheless unfortunate that it took so long, and even more disappointing given that One Chicago did not survive to operationalize the benefit of what we are doing today. Because, as has been pointed out, they discontinued all trading operations about a month ago on September 21st. I also regret that the adopting release issues opinions on hypothetical questions that I do not believe should be addressed here due to the unique change in circumstances presented by One Chicago's recent exit and the fact that no other U.S. exchange currently lists security futures for trading in this context. Let me explain. In response to a question we posed in the proposal of this rule, One Chicago urged the commissions to permit the use of risk-based margin models for security futures, similar to what is done for other futures contracts. While I generally support this risk-based margin methodology, I acknowledge that implementing such a sweeping change in response to a single question contained in a proposal designed to address a wholly different type of margin calculation was likely not achievable at this time. But today's release actually goes further and rejects One Chicago's interpretive arguments regarding the Commission's authority to adopt risk-based margining for security futures, and this concerns me. As Director Hutchison has pointed out, the Securities Exchange Act of 1934 requires margin levels for security futures consistent with and not lower than margin requirements for comparable exchange-traded options. In applying this language and in an attempt to be responsive to our inquiry, One Chicago raised several interpretive questions, including whether security futures contracts are in fact comparable to equity options, and also what influences demand for security futures. I do not believe that we should be offering advisory opinions on these interpretive questions that, in light of the demise of One Chicago, no CFTC or SEC registered exchange is currently asking. Due to the hypothetical nature of these questions, it is my view that they are not material given the circumstances before us, and should therefore be answered in real time when future CFTC and SEC commissions are presented with any live requests to list and trade security futures in that context only. You may be asking yourself why, if no one currently seeks to offer these products, am I so concerned with issuing a hypothetical opinion? It should be remembered that the trading of security futures on U.S. exchanges before the year 2000 was prohibited due to jurisdictional disputes over the treatment of products that have attributes of both SEC-regulated securities and CFTC-regulated derivatives. In the Commodity Futures Modernization Act of 2000, Congress repealed that prohibition and permitted security futures to trade on U.S. exchanges, pursuant to a framework of joint regulation. Yet today, the rejection of risk-based margining in the adopting release risks stifling the very security futures market that Congress intended to promote. Furthermore, and as has been noted by Chairman Tarbert, risk-based margining for security futures is permitted in Europe. And while factors other than margin requirements may influence demand for security futures, its rejection in the adopting release creates a potential competitive disadvantage for U.S. exchanges versus their international counterparts. The Commodity Exchange Act specifies that one of its purposes is to promote responsible innovation and fair competition among boards of trade and other markets and other participants. The interpretation in the adopting release fails to fulfill that purpose. Nevertheless, it is my sincere hope that while the reduction in margin levels from 20% to 15% may have come too late for One Chicago, it will be encouraging to other U.S. exchanges that may consider launching security futures. And in that event, it is my further hope that the Commission will bring an open mind to any interpretive arguments the exchange may advance at that time in requesting recognition of risk-based margining for its contracts. In the meantime, I draw a distinction between the matter that I've just discussed, risk-based margining, and that which we are advancing today. I support, therefore, the final rule that is before us, and I hope the discussion in the adopting release related to risk-based margining will not discourage U.S. innovation and competition going forward. I too have no questions, and I genuinely want to thank all of my colleagues for the tremendous effort in advancing this component of the rule, which I wholeheartedly support. Thank you, Mr. Chairman.
Thank you, Commissioner Stump, and thank you for your comments on risk-based margining. Much appreciated. Commissioner Lee.
Thank you. It's a pleasure to participate in today's joint meeting of the commissions. I know we've met together previously and also have approved many joint rules together, but as is noted by others, this is the first time we've met together to consider and vote on a rulemaking. So I'm very pleased to be able to participate today, and I very much appreciate the support, the collaboration between our agencies that the commissioners have discussed and celebrated today. I want to add my thanks to the staff at both the CFTC and the SEC for the work they've done on the two items we consider today, and much appreciation for all those who lent a hand in setting up the logistics of today's meetings. My remarks will be brief. We have a lot of folks to hear from and a lot of ground to cover. The history of how we got here was quite well and thoughtfully laid out by Director Hutchison of the CFTC, so I won't retread that ground. Today's release essentially seeks to provide equivalent treatment for unhedged security futures held in a CFTC-regulated account to that which is available for security futures held in an SEC-regulated account. And this change in margin from 20 to 15% is arguably modest, but after giving this much thought and reading through the comment letters, I cannot support proceeding with the rule at this time absent more analysis. As others have noted, demand for security futures has been historically low, and also as discussed in today's release, there are many possible factors for that unrelated to a modest difference in margin levels between two types of accounts. Since 2004, there's been only one exchange, One Chicago, that listed these products, and it has now closed its doors. That is very unfortunate, but it is not due to the difference in margin treatment available in an SEC-regulated versus a CFTC-regulated account, both of which accounts are currently available to market participants. In 2008, One Chicago petitioned for this rulemaking, seeking to lower the minimum margin from 20 to 15% for CFTC-regulated accounts. However, over time, their assessment evolved with experience in research, and by the time this rule was proposed, they were of the view that a drop from 20 to 15% would not address their concerns related to the appropriate margining for security futures. So there's a bit of an unusual situation in that the release responds at length to a request and comments from an entity that is no longer in existence, and the solution proposed does not resolve the concerns that entity raised. Given that no exchange is currently listing securities futures, there is time to more thoroughly evaluate some of the underlying complexities raised by commenters surrounding the comparability and the uses of these products so that we could have more confidence that our actions may support the intended outcome. As a result, I must respectfully dissent. Thank you.
Thank you very much, SEC Commissioner Lee. CFTC Commissioner Berkovitz, you have the floor.
Thank you very much, Mr. Chairman. I'd also like to thank my fellow commissioners, CFTC staff, and especially Chairman Clayton and the SEC commissioners and the SEC staff and the technical staff for all their hard work that went in today's meeting and making today's meeting possible. Congressman Mo Udall, who was a congressman when I first came to Washington, I attended, saw a number of hearings presided over by Chairman Udall, and Mo Udall said, fond of saying at committee meetings, everything has been said, but not everyone has said it. So I'll try to keep my remarks brief, but I really like to echo many of the sentiments of the preceding speakers regarding today's rule and the great collaborative work by the staffs of both agencies. And just observe, although today may be the first meeting, joint meeting that the two agencies have publicly, it's really just the latest in a long history of collaboration and behind the spotlight and behind the scenes hard work over many years. And Chairman Clayton referred all the way back to the Shad-Johnson Accord, which was negotiated by the two agencies and then ratified by Congress in statute. And I personally had the privilege of participating in the two really foundational joint rulemakings, the Dodd-Frank rulemakings to define swap and to define swap dealer. And really, the CFTC owes a long debt of gratitude that endures to this day for the SEC's commitment on those joint rulemakings. The SEC had a huge load arising out of the Dodd-Frank legislation, and we had to implement Title VII of the Dodd-Frank Act. But at the time, Chairman Shapiro of the SEC committed to Chairman Gensler of the CFTC to make those joint rulemakings a priority of the SEC, and that really enabled our swap implementation of Title VII to go into effect a number of years ago. And the SEC placed those rulemakings at the very top of its priorities in collaboration with the SEC, and I'm forever appreciative of the commitment of the SEC staff and the hard work. And I note that one of the SEC staff people who worked on these rules today, Ajay Sudaria, was in our office at the CFTC at that time. And the agencies have a long history of personnel going back and forth from the CFTC and SEC as well. So today's effort really is the latest in a long line of collaboration. And I think the commissioners of both agencies, Commissioner Quintens and Commissioner Peirce, are really the latest in a long tradition in that respect. And I'd like to also express my appreciation from carrying on that tradition in that regard. Today also, harmonization, today's rulemaking is just one aspect, just one area in which the two agencies, and our agency in particular, continues to consider harmonization. Harmonization we've considered recently in our cross-border rules. We did commodity pool operator rules a couple of weeks ago, in which harmonization was a major factor. They're in our swap dealer reporting rules. Across the board, really, harmonization is something we consider in all our rulemakings. It's not easy. There's challenges. There's different markets. The agencies have different traditions, and most significantly, as we've heard in some detail already today, our underlying statutes are different. So some areas, I think we've been more successful in our harmonization efforts, and some areas success has really not been 100%. And I think the One Chicago example, despite our best efforts, it's unfortunately too late for One Chicago. But there is a commitment on both agencies, and within the statutory constraints, we're operating under, at least I'm committed, and I know my colleagues are all committed to working through these issues as diligently as we can. Turning to the rule, I'm going to be supporting the rule. I think it's a overdue equalization of the margin requirements for security futures held in a futures account as opposed to a portfolio margining account, for the reasons that have been explained in the presentation by Clark and articulated by a number of other commissioners. So I'm going to be supporting the rule for us today. Again, in conclusion, I'd like to thank the chairman and commissioners of both agencies and the staffs of both agencies for their work in today's rulemaking. May be too late for One Chicago, but nonetheless, it represents the agency's commitment to addressing this issue and continuing to look for ways, if today's solution or today's rulemaking is not a solution to the problem, look forward to continuing to work on ways to develop a solution that can benefit the market in the near term. So again, thank you very much.
Thank you, Commissioner Berkowitz. I just want to echo two things you said, which is the importance of the cross-pollination that we've had over the years between our agencies, and also the need for this kind of work across the board, including our reaction to the market stresses of March and April and how to improve our markets. And I want to thank the CFTC staff for being open and helping us with that analysis. With that, Commissioner Crenshaw, please.
Good morning. This is Commissioner Caroline Crenshaw with the Securities and Exchange Commission. Thank you to the chairman and to all of my fellow commissioners, as well as to the dedicated staff who have been mentioned already this morning, those who have worked on the rules today and the proposals, the request for comments, as well as those who have ensured a successful meeting here this morning. So again, thank you to all of you. I'm not going to belabor the points that have already been made pretty extensively, but I am pleased that we are holding this joint meeting today. Coordination between the SEC and the CFTC is critical to the effective regulation of the closely connected markets that we oversee. Turning to today's agenda, we are considering first whether to adopt rule amendments that would lower the required margin on security futures. While the adjustment is modest, from a minimum margin level of 20% to 15%, I do not believe we have articulated a sufficient rationale for making this change. We have not explained why the existing margin is too high or otherwise identified a problem that would be solved by lowering the required level of margin to 15%. Nor have we pointed to any problems that have resulted from the differing margin requirements for securities accounts approved for portfolio margining on the one hand, and securities and futures accounts not approved for portfolio margining on the other. The release states that lowering the margin may increase competition and investor participation in the market for securities futures by putting them on a more level playing field with comparable options and by aligning the requirements for security futures held in different types of accounts. However, the evidence we have about the nature of this market seems to indicate that the lack of popularity of these products is due to factors other than margin. First, our rules already permit security futures to be held in a portfolio margin account subject to a minimum margin of 15%. But, as the release notes, investors have not taken advantage of this option. Instead of continuing to hold these products in futures accounts subject to the higher 20% minimum level of margin. Second, the release explains that there are other issues, such as tax treatment and competition from foreign markets, that may limit investor demand. The issues would not be addressed by today's amendments. Third, as pointed out by the commenters and acknowledged in the release, investors will continue to be able to obtain similar exposure at a lower cost from other products, such as OTC total return swaps and stock loans. I am thankful to the staff of the two agencies for their hard work on this release. Again, I recognize that today's change is modest and that security futures have utility to certain investors in the markets. However, I am wary of lowering the required margin on highly levered products in the absence of evidence that will address the issues that we have identified. Therefore, I thank everybody again, but I respectfully dissent.
Thank you very much, Commissioner Crenshaw. This is CFTC Chairman Tarbert, and I think now that all commissioners have had an opportunity to make remarks and ask any questions they may have, we will now proceed to vote. And we will vote separately, as I mentioned early on in the meeting. So we'll start first with the CFTC. So I will ask the following question. Is there any CFTC commissioner who is not prepared to vote? Okay, hearing no response, all CFTC commissioners are prepared to vote, so I will ask Mr. Kirkpatrick, our secretary, to please call the roll for the motion to adopt the final rule amending the customer margin requirements relating to securities futures.
Thank you, Chairman Tarbert. This is the CFTC Secretary speaking. The motion now before the CFTC is on the adoption of the final rule amending the customer margin requirements relating to security futures. Commissioner Berkovitz.
Commissioner Berkovitz votes aye.
Commissioner Berkovitz votes aye. Commissioner Stump.
Commissioner Stump votes aye.
Commissioner Stump votes aye. Commissioner Benham.
Commissioner Benham votes aye.
Commissioner Benham votes aye. Commissioner Quintens.
Commissioner Quintens votes aye.
Commissioner Quintens votes aye. Chairman Tarbert.
Chairman Tarbert votes aye.
Chairman Tarbert votes aye. Mr. Chairman, on this matter for the CFTC, the ayes have 5, the noes have 0.
Thank you, Mr. Secretary. I'm pleased to say that the ayes have it, and the motion to adopt the final rule is hereby approved by the CFTC. Now I'll hand it over to SEC Chairman Clayton.
Thank you. We will take the vote in our usual way. On the matter before the Commission, Commissioner Peirce, how do you vote?
This is Commissioner Peirce, and I vote yes.
Commissioner Roisman, how do you vote?
I vote yes.
Commissioner Lee, how do you vote?
I vote no.
And Commissioner Crenshaw, how do you vote?
No.
And I, Chairman Clayton, vote yes. Thank you. Thank you all. With that, we're going to move to the second item on our agenda, the recommendation to issue a request for comment on portfolio margining. Director Redfern of the SEC's Division of Trading and Markets will provide the staff's recommendation. Brett, over to you, please.
Thank you, Chairman Clayton and Chairman Tarbert. Good morning. This is Trading and Markets Director Brett Redfern. The staffs of the SEC and CFTC recommend that the commissions jointly issue a request for comment on the portfolio margining of non-cleared security-based swaps and uncleared swaps, along with related positions. The staffs have worked collaboratively on drafting the recommended request for comment. In doing so, they've sought to highlight areas where comment would be particularly helpful to the commissions as they further consider the merits of portfolio margining and the various alternatives to implementing a portfolio margining program. Portfolio margining of non-cleared security-based swaps and swaps, along with related positions, would involve holding all of these products in a single account. Positions in the account that offset each other, for example, a basket of long total return equity security-based swaps and a short total return swap on a broad-based equity index, would be combined to reduce the margin requirement of the account holder. In addition, related positions such as long and short cash securities positions, listed options, futures, and options on futures potentially can be combined with offsetting security-based swaps and swaps to reduce the account holder's margin requirement. Of course, an entity's ability to offer portfolio margining of different product types will depend on its registration status, i.e., as a broker-dealer, security-based swap dealer, futures commission merchant, and/or swap dealer. The request for comment would take into account these different types of registrants. In addition, the type of account in which the portfolio margin products are held can have regulatory, legal, and operational implications. More specifically, depending on the entity's registration status, it could offer portfolio margining in a securities account, a security-based swap account, or a swap account. The request for comment would ask about portfolio margining in each of these account types. The request for comment also would take note of certain differences in the margin and segregation requirements of the SEC and the CFTC. Comment would be sought on how these differences should be addressed in the context of portfolio margining. Portfolio margining can promote efficiencies in calculating and collecting margin, and it can alleviate excessive margin calls, improve cash flows and liquidity, and reduce volatility. At the same time, portfolio margining of uncleared swaps and non-cleared security-based swaps and related positions requires careful consideration to ensure that any customer protections, applicable regulatory issues, and potential impacts are appropriately considered and addressed. For these reasons, the SEC and CFT staffs CFTC staffs recommend the commissions jointly seek comment on the matters I've discussed. Finally, I really want to thank the SEC and CFTC staff members who worked on drafting the recommended request for comment. The thoughtful analysis of the implications and issues surrounding portfolio margining of these products has produced a request for comment that flags important matters for which public comment would be very helpful. It's great to see the staffs of the SEC and the CFTC working so closely together on this request for comment, and also the customer margin rules covered earlier, as well as other things. So the SEC and CFTC staff and I are available to answer any questions you may have about the request for comment. Thank you.
Brett, thank you very much. I'm now going to turn it over to Chairman Tarbert for his opening remarks.
Well, thank you very much, Chairman Clayton and Brett and the rest of the team at the SEC. To begin the CFTC's discussion and consideration of this rulemaking or this proposal, I now entertain a motion to adopt the request for comment on the portfolio margining of uncleared swaps and non-cleared securities-based swaps.
So moved.
Second. Thank you. Let me first begin by thanking the following CFTC staff for their work on this request for comment. From our Division of Swap Dealer and Intermediary Oversight, Josh Sterling, Director, Tom Smith, Deputy Director, Josh Beal, Associate Director, and in addition to that, Paul Schlickstein, our Associate General Counsel at the CFTC. Portfolio margining is of central importance to market participants who are duly registered with the SEC and the CFTC and have customers who hold positions in separate accounts without the ability right now to cross-margin the positions. And the whole area of margining and who holds margin, and depending on whether you're a broker-dealer registered with the SEC or you're a swap dealer without that affiliation, it's obviously an area where there have been significant differences in approaches over the years. So therefore, I think it's an area that's ripe for further discussion. And I will note that this request for comment is actually the direct result of efforts by both you, Chairman Clayton, as well as my own predecessor at the CFTC, Chairman John Carlo. Both of you asked the staffs of the SEC and CFTC to conduct market outreach and seek further input from the public regarding issues surrounding portfolio margining. And so I was pleased to continue that process when I came in the door. And I'm, of course, pleased to support this request for comment because I think it will enable our respective staffs to prepare a thoughtful recommendation on actions that our two commissions might take in the future to facilitate portfolio margining. So I think it's very straightforward, but it's in many ways sort of a critical first step in generating this discussion. So I have no questions and grateful for your leadership on this, in particular, Chairman Clayton.
Well, thank you very much, Chairman Tarbert. I think, as is often the case, we've been led by the staff here. Most of our good ideas bubble up from our colleagues on the staff. So I'll just note that in 2019, as part of the final rulemaking adopting capital margin and segregation requirements for security-based swap dealers, the SEC stated that it would need to coordinate further with the CFTC to implement the portfolio margining of uncleared swaps and non-cleared security-based swaps in a single account. Today's recommended request for comment is designed to facilitate this coordination by asking market participants and other interested parties to provide information and their views on portfolio margining. The objective is to gather information to help us carefully consider how portfolio margining might promote greater efficiencies and also how to address any potential customer protection, financial stability, and other regulatory impacts that might result from portfolio margining. Since 2012, the commissions have coordinated to permit the portfolio margining of cleared credit default swaps that are swaps and security-based swaps in a CFTC cleared swaps account. The request for comment on the portfolio margining of uncleared swaps and non-cleared security-based swaps is another important step for our agencies to continue our collaborative efforts and dialogue to explore whether and how increased harmonization in portfolio margining would better serve our markets and our investors. I very much look forward to public comment. Today's actions are the result of our staff's diligent efforts and collaboration with the CFTC staff, and I am proud to support the staff's efforts in this area. Thank you, and back to you, Chairman Tarbert.
Thank you. I think we can go ahead this time and start with the SEC commissioners first. So that would be Commissioner Peirce.
Thank you, Chairman Tarbert. Title VII of the Dodd-Frank Act mandated a massive overhaul of the regulatory framework governing swaps and security-based swaps. And one of the most significant of these changes is the requirement that swap and security-based swap dealers be subject to minimum initial and variation margin requirements for uncleared swaps and non-cleared security-based swaps. These requirements are intended to reduce various risks associated with those transactions. At the same time, they impose significant costs on counterparties to these trades, as funds that could be put to other productive uses are set aside to mitigate these risks. Portfolio margining, or the cross-margining of related positions, can reduce these costs in a manner consistent with prudent risk management by allowing the netting of offsetting exposures. Different types of products can provide exposure to similar risks, but one of the unique features of the U.S. financial markets is that jurisdiction over these products and the dealers who intermediate transactions in these products is divided between the SEC and the CFTC, and each agency has its own margin requirements. These jurisdictional and legal differences make it difficult or impossible for market participants to achieve the efficiencies that would be possible if they could prudently offset these exposures through portfolio margining. Regulatory margin requirements sometimes stand in the way of effective, safe, and efficient portfolio margining. So finding a solution to these issues that will work for participants in our markets is going to require a lot of hard work on the part of our two agencies, but it's a very important objective. Both agencies have made policy choices over the years that reflect the idiosyncrasies of our respective markets, the risk characteristics of the products we regulate, and the decades-long legacies of our respective approaches to the regulation of margin and capital requirements that apply to our regulated entities. As the commissions examine how to make portfolio margining a possibility for the firms we regulate and across the product types that we regulate, we need to be sensitive to the ways that our different approaches create unnecessary complexity for market participants and determine how we might enable market participants to benefit from prudent risk management practices while still achieving the regulatory objectives of our respective regimes. Doing this is going to require frank, open dialogue between the two commissions and our staffs, as well as intensive engagement with the public, including those who are active across these markets. The request for comment that we're considering today is the first step of this process. The document invites engagement on a wide range of issues relating to the portfolio margining of uncleared swaps and non-cleared security-based swaps, both with each other and with other products in both SEC and CFTC regulated entities. I hope that market participants and other interested members of the public will respond in detail and where possible with analyses of the efficiencies that portfolio margining can generate and suggestions for how the commissions can continue to advance what each of us has identified as important policy objectives while also permitting firms to benefit from these efficiencies. Speaking of public input, I also have gotten repeated requests that the exemptive relief that the Commission granted in 2012 for portfolio margining of cleared swaps and security-based swaps needs to be revisited. Indeed, Brian Quintens and I have been together at meetings where he has sat smiling as I've received some of that feedback. I agree and hope that we will follow up with something in short order on that front as well. Thank you to the staff of both agencies who have worked on this request for comment. I look forward to working with you as we receive input from interested members of the public, and I have no questions. Thank you.
Thank you very much, SEC Commissioner Peirce. CFTC Commissioner Quintens, you have the floor.
Thank you, Chairman Tarbert. This is Commissioner Brian Quintens of the CFTC. I'm very proud to support today's request for comment, which marks the beginning of the agency's public consideration of ways to implement portfolio margining regimes for uncleared swaps and non-cleared security-based swaps. Although, Chairman Tarbert, as you mentioned, this was initially aired through a joint statement by Chairman Clayton and then Chairman Giancarlo a few years back. I remember having follow-on conversations about trying to get this over the finish line at the early part of this year, and then we all went virtual, but we stuck with it and we're getting it done. And I couldn't be prouder to see this come to fruition. Portfolio margining can lead to efficiencies in margin calculation by appropriately accounting for the impact offsetting positions have on a portfolio's actual risk profile. This in turn gives firms and customers additional capital that can be deployed elsewhere. However, given the differences between the regulatory regimes for swaps and security-based swaps, it also implicates incredibly important legal and policy considerations. This request for comment solicits critical feedback from market participants on how portfolio margining could impact the safety and soundness of firms, result in competitive advantages for certain types of registrants, raise questions about how collateral will be treated in the event of bankruptcy, but also make more efficient our markets and how they work together. In order to make informed decisions about if and how portfolio margining should be implemented for uncleared swaps and non-cleared security-based swaps, we need thoughtful feedback on these very complex questions. So I encourage all interested parties to provide written comments, including data wherever possible, in order to further the agency's understanding of the various options presented in this request for comment. It is a great document. I'm grateful to DSIO Director Sterling, Tom Smith, Josh Beal, and Paul Schlickstein, and to SEC Trading and Markets Director Redfern and your team for getting this product before us. And lastly, Mr. Chairman, if I could, I would just like to recognize one of my own staff members. This is the last open meeting that Margot Bailey is going to be with my office. Since joining my office in 2017, she has worked both tirelessly and incredibly effectively, but always with an unflappable, cheerful, sunny disposition. She's handled some of the most complicated rulemakings we've undertaken, helped me craft my ideology and policy goals into public statements, and has been one of the tips of the spear on the harmonization efforts with the SEC. Most importantly, as a highly trained lawyer, she's had to deal with staffing a non-lawyer commissioner. I consider myself and the markets incredibly lucky to have had her with my office and consider her a close friend and wish her all the best. Thank you.
Commissioner Quintens, thank you for the comments regarding the proposal and the request for comment, but also thank you for the comments regarding Margot. I think we all recognize that we couldn't do any of what we do without our incredibly committed staffs. With that, we'll go to Commissioner Roisman, please.
Thank you, Mr. Chairman. I'm supportive of seeking comment on portfolio margining of uncleared swaps and non-cleared security-based swaps, and commend the staffs at both agencies for continuing to pursue areas that may be ripe for regulatory harmonization. As I have stated before, the SEC's regulatory approach in this area should reflect the reality that most market participants that are active in the security-based swaps market are also active in the swaps market. Seeking out areas that may benefit from a harmonized regulatory framework has the potential to result in more effective and efficient oversight that limits unnecessary costs. This is not to say that I believe the SEC should completely defer to CFTC regulations. Rather, efforts to minimize deviations in regulatory frameworks should reflect careful, deliberate consideration of the differences in our markets and regulatory structures. Issuing a request for comment, as we are considering today, is a prudent first step when exploring areas for regulatory harmonization. Public comment is critical to receiving necessary feedback on whether we can fairly and effectively develop a harmonized approach to portfolio margin requirements. I encourage market participants to consider the issues implicated by harmonization in this area, particularly with respect to capital, segregation of customer property, bankruptcy implications, and any other operational issues. Thank you to the SEC staff and the Division of Trading and Markets and the Office of General Counsel, as well as to the incredible CFTC staff for their work on this request for comment. I have no questions, and thank you again. Thank you very much, SEC Commissioner Roisman. CFTC Commissioner Benham, you have the floor.
Thanks, Mr. Chairman. I am pleased to support this request for comment on potential ways to implement portfolio margining of uncleared swaps and non-cleared security-based swaps. As one who often comments on the importance of process, I'm pleased that the commissions are beginning here. At the highest level, portfolio margining is where our two sets of margin rules intersect. It sounds simple, but there's much to reconcile in terms of calculation, collection, protection in the event of a default, and much more. The questions focus on drawing out the various considerations and notable differences in our respective margin rules identified by staff at our agencies, with a goal of advancing a program even though we are in the very nascent stages of policy development. I believe beginning with a request for comment is an important first step because it builds accountability by promoting greater transparency and engagement with the commissions throughout the decision-making process and supports the highest levels of collaboration internally and I think most importantly with the public. So I would certainly echo my fellow commissioners' comments in encouraging the public to engage, to provide us information so that we can make the best and most informed decisions as we proceed with this important process and policy deliberation. I look forward to the comments and will be especially interested in hearing about new approaches, tools, practices, and processes that may contribute to our deliberations with an emphasis on financial stability, market resiliency, and integrity, and of course, customer protections as we move forward in this process. Thank you, Mr. Chairman. Thanks, Chair Clayton as well. And of course, thanks to all the staff, DSIO, within the CFTC and SEC staff for putting together this very exhaustive and comprehensive document and questions. Look forward to public comment and contributions from the public and private stakeholders. Thank you.
Thank you very much, Commissioner Benham. We'll now go to Commissioner Lee from the SEC.
Thank you. I support sending out this request for comment and exploring the issues that it presents, and I appreciate very much the responsiveness of our trading and market staff to the comments and questions from my office during the drafting process. Portfolio margining, when well designed, can offer capital efficiencies by better aligning margin requirements with the overall financial risks inherent in a specific participant's position. We should be cautious, however, in our approach to portfolio margining for uncleared swaps and non-cleared security-based swaps in a single account for a number of reasons. The differences in the markets our commissions oversee and our different regulatory regimes can complicate portfolio margining across these two types of assets. For example, the commissions have different regimes for handling the insolvency of a futures commission merchant versus a broker-dealer. There are differences in whether two-way or one-way margin is required for swap and security-based swap positions that can have implications for customer protection. And depending on the types of assets included, there can be differences in how difficult it is to liquidate or transfer a portfolio in a default scenario. So I look forward to hearing from comments as to if or how these differences may be addressed and on all the other issues that are raised in the request for comment. And again, I want to thank the staff at the CFTC and the SEC for their work in putting this together. Thank you.
Thank you very much, SEC Commissioner Lee. CFTC Commissioner Stump, the floor is yours.
Thank you. I simply wish to say that I look forward to receiving comments on this very important topic. I have some past experience with previous efforts regarding portfolio margining, and I know we are going to approach this with a can-do attitude. The CFTC and the SEC have worked together in the past to overcome our differences, and I think that is extremely important to bring to the open-mindedness that we bring to receiving comments in this context is quite important to me as well, and I know to others. As has been mentioned by Chairman Clayton, there were efforts to ensure that we could allow for broker-dealer FCMs to portfolio margin single-name security-based credit default swaps under the jurisdiction of the SEC and cleared indexed credit default swaps under the CFTC's oversight. And I believe that there may be more work to do, as Commissioner Peirce suggested, but I believe this challenge continues to demand our attention, both in the context of the cleared products and the uncleared products that we're considering today. And I know we are up to the task. It's frankly critical that we remain up to the task because we are the U.S. market regulators. and market participants are often engaged in cleared, uncleared, listed, and OTC transactions. And regardless of whether these products are within the CFTC or the SEC's oversight, we should not ever allow jurisdictional lines to obstruct the market's ability to account for risk on a portfolio basis where it is most appropriately realized and accounted for. Today, we face a new challenge. Each regulator has pursued a different path when adopting the margin policies for positions that are not cleared, positions that are likely part of a portfolio. So I do have one question. With that context, I'm hoping that Tom or Josh might address, the practical impacts of the market participants, the market structure, and the risk management as a result of these divergent approaches to the margin rules for those transactions that are not cleared.
Madam Commissioner, this is Director Sterling of the CFTC. Thank you for that question. I'll be happy to answer it. I think the bottom line is to appropriately evaluate and be fully responsive to your question. We will be in a much better position after we receive public comment on the release. For now, we continue to support the existing framework, as I'm sure the SEC does, but we look forward to working through all the comments we receive, all the information we're hopeful to receive, and continue to coordinate with Director Redfern and his staff at the SEC.
Thank you, Director Sterling. I have no further questions. I'm extremely pleased we are putting forward an opportunity for the public to comment on this, as I think it's critically important. I know when Commissioner Peirce and I were in very different positions during the development of the Dodd-Frank legislation, we often heard from market participants who were anxious about these exact obstacles when it came to properly recognizing the risk and the potential for there being competing and divergent controversy amongst the regulatory agencies. And so I hope that we will be able to advance the cause in a way that enables the market participants to most efficiently manage their risk. Thank you.
Thank you, Commissioner Stump, for the comments and noting that we have taken different paths in the past. I will just note that our staffs are putting together, with respect to the fact sheets that go out with this, a nice chart that summarizes the different paths that we have taken and where we stand today. With that, Commissioner Crenshaw, please.
Thank you. As has been noted, we are also considering today whether to issue a request for comment regarding portfolio margining for uncleared swaps and non-cleared security-based swaps held in the same account. This is an area in which both the commissions should proceed with caution. Without a central clearing counterparty, the risk of default is borne by the parties to the transaction. The risks are particularly acute where the transaction is complex and customized, which is often the case with respect to uncleared swaps and non-cleared security-based swaps. Ensuring that sufficient margin is available to help cover losses in the event of a default is a key source of protection for the financial system. There are many challenging issues that we will need to address in order to move forward on this topic. I will just briefly note a few. First, as summarized in the release, the rules that apply to the transactions, accounts, and intermediaries in this space are complex and varied. The commingling of uncleared swaps and non-cleared security-based swaps, therefore, has the potential to create confusion about the availability of margin in a liquidation situation. This, in turn, could lead to greater risks for counterparties and for the financial system overall. Second, uncleared swaps and non-cleared security-based swaps can be subject to varying liquidity conditions, replacement costs, and counterparty risks. Even where positions may appear to offset one another, these factors may increase the overall risks of a portfolio. Finally, the effectiveness of a portfolio margining approach depends on the effectiveness of the models used. It is extremely important that the commissions are able to exercise sufficient oversight of the approaches used by industry members. I am thankful to the staffs of both agencies for their work on this release. While I do have concerns about the risks presented by portfolio margining, I hope that commenters will provide input on whether this is an advisable course of action for the commissions to follow and how some of the risks might be mitigated. I believe a request for comment is an appropriate place to begin this consideration. Therefore, I support today's action, and thank you again to everyone who's helped put this forward today.
Thank you very much, SEC Commissioner Crenshaw. CFTC Commissioner Berkovitz, you have the floor.
Thank you, Chairman Tarbert. I'm pleased to support the request for comment today. I want to commend the staffs of the two agencies on really an excellent document. In my view, it really does the public a great service rather than just posing a number of questions that we would like answered, to really lay out the issues, the statutory background, and the challenges that we face on these issues. I think it's a really helpful document to the public, really informative as to what the issues are, and seeks very thoughtful comments and responses that will really enable us to hopefully make some progress on this issue. So I'm very much looking forward to the comments that we do receive on it. But again, I'd like to commend the staffs of both agencies for their work on the document itself. I really think it's a model for how to address a complex issue and to seek meaningful and informative public comment. So I'm pleased to support the document, and thank you again.
Thank you, Commissioner Berkovitz, and I wholeheartedly agree with you on the staff's work and the level setting that this document provides. With that, Chairman Tarbert, I believe we're proceeding to voting and that the SEC will go first.
That is correct, Chairman Clayton.
Thank you. Thank you very much. And we will go in our usual order. On issuing the proposed request for comment, Commissioner Peirce, how do you vote?
This is Commissioner Peirce, and I vote yes.
Commissioner Roisman, please.
This is Commissioner Roisman, and I vote yes.
Commissioner Lee, please.
This is Commissioner Lee, and I vote yes.
And Commissioner Crenshaw, please.
I also vote yes.
Thank you all. This is Chairman Clayton, and I vote yes. Over to you, Chairman Tarbert.
Thank you very much, Chairman Clayton. This is CFTC Chairman Tarbert. I will ask the following question. Is there any CFTC commissioner who is not prepared to vote? Hearing none, I'll now ask our Secretary, Mr. Kirkpatrick, to please call the roll for the request for comment on the portfolio margining of uncleared swaps and non-cleared securities-based swaps.
Thank you, Chairman Tarbert. This is the CFTC Secretary speaking. The motion now before the CFTC is on the request for comment on the portfolio margining of uncleared swaps and non-cleared security-based swaps. Commissioner Berkovitz.
Commissioner Berkovitz votes aye.
Commissioner Berkovitz votes aye. Commissioner Stump.
Commissioner Stump votes aye.
Commissioner Stump votes aye. Commissioner Benham.
Commissioner Benham votes aye.
Commissioner Benham votes aye. Commissioner Quintens.
Commissioner Quintens votes aye.
Commissioner Quintens votes aye. Chairman Tarbert.
Chairman Tarbert votes aye.
Chairman Tarbert votes aye. Mr. Chairman, on this matter for the CFTC, the ayes have 5, the noes have 0.
Thank you, Mr. Secretary. I'm pleased to say that the ayes have it, and the motion on the request for comment is hereby approved by the CFTC. So now I think we have just one very quick item of business left that Chairman Clayton alluded to earlier in the meeting. Before we adjourn, Chairman Clayton.
Thank you, Chairman Tarbert. And I want to start by noting what a great job our staffs have done in our telework environment of continuing to move the important work of our commissions. Just remarkable that we've been able to accomplish so much not being together. For this last item, I wish we were together, because I do wish that I could present this personally to Commissioner Quintens. And what I am foreshadowing here comes from many of the comments that were made earlier today about the work of Commissioner Quintens and Commissioner Peirce in facilitating the coordination among our staffs to bring the Title VII regime over the finish line, and bring it over the finish line in a way that Commissioner Benham noted, that it is something that is there, but we will continue to vigilantly monitor as we go forward. So on a personal level and on behalf of the many colleagues here at the SEC who work diligently to stand up the Title VII regime, I want to present Commissioner Quintens with the SEC's Chairman's Award for Regulatory Excellence. This is for your leadership in advancing the cooperation between the CFTC and the SEC to stand up a Title VII regulatory regime that promotes integrity, resilience, and vibrancy of the U.S. swaps and security-based swaps market. Brian, on my personal level and professional level, and on behalf of my colleagues who worked with you at the SEC, thank you very much, and please accept this as a small token of our gratitude.
Thank you, Mr. Chairman. Thank you so much. Such an honor. Such an honor. Thank you.
Well, Brian,
terrific. Outstanding. Well, this is Chairman Tarbert of the CFTC, and I have, first of all, want to echo Chairman Clayton's remarks regarding the agencies and how they've enabled us to work remotely and to be so productive during this critical time in American history. And I, too, wish we could be there in person, but for those of you that are watching our webcast, you'll see the two awards up, and I am very pleased to present the Mirror Award to SEC Commissioner Hester Peirce, the CFTC Chairman's Award for Regulatory Excellence for her work on Title VII. And Chairman Clayton just asked me to sort of quickly go through the kinds of things that our two commissioners, Commissioner Peirce and Commissioner Quintens, have been able to achieve over the last couple of years. They've helped update and expand existing MOUs regarding areas of shared regulatory interest, including examinations of joint registrants. They've helped harmonize many critical aspects of SEC rules on capital margin and segregation for duly registered broker-dealers, securities-based swap dealers, and the CFTC's regulations on those same subjects for futures commission merchants and swap dealers. They've also worked together to try to help us harmonize swap data and real-time reporting for both swaps and securities-based swaps. They've also helped further harmonize cross-border entity and transaction level requirements for the dealing of swaps and securities-based swaps. They've initiated discussions on the review of Form PF, and they've helped initiate and develop the request for comment, this one on portfolio margining that we just voted on unanimously with both of our commissions. And then finally, they promoted and initiated joint dual registrant examination cooperation between the SEC and the National Futures Association. So that is the official accomplishment of what these two dedicated public servants have done over the last few years. But I just want to say on a personal note, Commissioner Quintens has been truly an outstanding colleague during my tenure at the CFTC. And Commissioner Peirce and I started working on Title VII issues before there was a Title VII, when we were colleagues on the Senate Banking Committee back 11 years ago. So both I consider to be not only outstanding colleagues and experts in financial regulation, but also friends. So it's my honor to bestow this award on you, Commissioner Peirce, and to see Chairman Clayton bestow the similar honor on Commissioner Quintens. So back to you, Chairman Clayton, for adjournment of the meeting.
Chairman Tarbert,
please.
I just want to thank you for those very kind words and for the award. I do have to say that the award that I'm accepting reflects the hard work of the staff at the SEC, who have been so patient in working with me and so devoted to this task. Really from day one, I've just been delighted to work with them. So any recognition that I'm getting really belongs to them. And I have to highlight specifically my staffer, Richard Gabbert, who has been fantastic on these issues and has worked harder than anyone could imagine someone would work. He lives and breathes Title VII, which is not always healthy. And I also want to just echo my thanks to Margot. I'm sad to hear that today is her last meeting. She's been wonderful to work, for our office to work with as well, and so just really want to thank her for her work. So thank you to everyone. Thank you, Chairman Clayton, as well for enabling me to work on these issues.
Terrific, and many congratulations to you both. So Chairman Clayton, would you like to adjourn the meeting from the CFTC, the SEC side?
Yes, thank you very much. I want to just say again, thank you to you and to the CFTC commissioners. A big thank you to my colleagues, the SEC commissioners, for bringing this together and for the work to date. And with that, the SEC part of this meeting is adjourned.
Terrific. This is Chairman Tarbert of the CFTC. I want to take just a second to thank all of those who attended today, as well as my fellow commissioners from both commissions. And there being no further business, I'd like to entertain a motion from the CFTC to adjourn the meeting.
So moved.
Second.
Those in favor of adjourning the meeting will say aye.
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 Those opposed, no. Well, the ayes have it, and once again, I'm grateful particularly to the SEC and the CFTC staff for their outstanding work in making this meeting possible. The meeting is hereby adjourned. Thank you all.